Stocks and bonds moving together. Why it matters. For the past 20 years, bonds acted as a safety net when stocks crashed. When equities dropped, investors fled to the security of treasuries, pushing bond prices up. This negative correlation was the backbone of the classic 60-40 portfolio. But now, that safety net is ripping apart, and it changes everything about how you need to invest. The stock-bond correlation recently hit plus 0.60, the highest positive reading since the late 1990s. This means when stocks fall, bonds are now likely to fall too. JP Morgan's research highlights this as a structural shift, not a temporary anomaly. Their analysts warn, the era of reliable negative correlation between stocks and bonds appears over, signaling a fundamental change in market dynamics. 2022 was the first major test of this new reality. Both stocks and bonds fell simultaneously, a rare occurrence in modern portfolio history. The classic 60-40 portfolio lost 16% that year, its worst performance ever recorded. Investors who thought they were diversified were hit hard on both sides of their portfolios. The root cause lies in inflation. Historically, when stocks fell due to economic weakness, the Federal Reserve would cut rates to stimulate growth. Those rate cuts boosted bond prices, creating the negative correlation. But with inflation stubbornly high, the Fed can't cut rates even if growth slows. This removes the mechanism that once made bonds rise when stocks fell. Debt levels add another layer of complexity. With $37 trillion in national debt, interest rates now respond more to fiscal concerns than monetary policy. When investors worry about debt sustainability, they sell both stocks and bonds, creating a positive correlation where none existed before. The implications are profound. Traditional portfolio construction rules no longer apply. Diversification across asset classes won't protect you if everything moves together. Vanguard's models suggest the 60-40 portfolio's 5% average annual return over the past 20 years could drop to just 2 to 3% going forward, a sobering outlook for long-term investors. Hedge funds and institutional investors have already felt the impact. Bridgewater Associates, known for its risk parity strategies, reported significant losses as their models failed to account for this shift. These strategies relied on bonds offsetting stock declines, a dynamic that no longer holds. Retirement planning faces similar challenges. Target date funds, which assume bonds will stabilize portfolios during equity sell-offs, may no longer provide the cushion retirees expect. A 10% stock market drop could now result in an 8 to 9% portfolio loss instead of the 5 to 6% investors were accustomed to. Corporate pension funds are also at risk. They rely on bonds to match liabilities, assuming stable or rising bond prices. If bonds fall alongside stocks, funding gaps could re-emerge, undoing years of progress. Even risk parity ETFs, designed for a different market regime, have struggled. The largest funds lost 30 to 40% in 2022 as leveraged bond positions amplified losses instead of mitigating them. The insurance industry isn't immune either. Life insurers hold trillions in bonds to back policies. Falling bond prices during equity stress could erode their capital buffers just when claims spike, creating systemic risks regulators are only beginning to address. Municipal bonds, once seen as a safe haven, also faltered. In 2022, munis fell nearly as much as treasuries, leaving high net worth investors exposed. Commodities like gold and oil have emerged as rare hedges, often rising when both stocks and bonds fall. However, they bring their own volatility and lack the steady income streams bonds once provided. Alternative assets such as private credit and real estate may offer some relief, but they come with liquidity trade-offs. Many alternatives also correlate more with public markets than investors realize. The Fed's balance sheet reduction amplifies these trends. When the Fed was buying bonds, it suppressed volatility across assets. Now, as they shrink their holdings, market moves have become more violent and correlated. This quantitative tightening could persist for years. Foreign buyers add another wrinkle. As China and Japan reduce Treasury holdings, the market loses a stabilizing force. These central banks often bought during sell-offs, and without them, downturns could become more severe.